Yeah, please start.
Yes, sir. So let us start with 45(5)(a). So this, the finance minister told us that this is a benefit. Sir, what was happening earlier, my dear friends? Joint development agreements. The issue started with the Mumbai High Court of Chaturbhuj Daras Kamadia, wherein the Honorable Mumbai High Court held that on the very day of entering to joint development agreement, there is a transfer. So transfer means it is given into within bracket 47, includes sale, exchange, relinquishment, etc. etc. Then you come there, go within bracket 47(5), says part performance of contract, ready with section 53 of Transfer of Property Act 2 47(6) is member of a cooperative society. Those two sections were invoked by Mumbai High Court in Chaturbhuj Daras Kapadia. What was the case? The judgment was delivered in 2000 and then attained finality by Seshasai Steels in 2020. So 20 years, imagine 20 years litigation went to Supreme Court. What was earlier, what is now, and as a result of this Supreme Court judgment, there is an amendment in 45(5). A new section is introduced, rather not amendment. So what was Mumbai High Court in Dwarkada's Kapadia telling Chaturbhuj Daras Kapadia? The day of entering the joint development agreement amounts to transfer. Please pay tax. What a joke. I entered into a joint agreement with Kamlesh. What a 30-40 cent. Landowner, I don't have capital, so I don't have money. I cannot construct property. So what I did, I gave to Kamlesh Builders. I gave him the set. I entered into a joint development agreement. Very good. So Kamlesh will take say 5 years. And I gave a sign, say 60-40 ratio, 60% of built-up area Kamlesh will give it to me. 40% of built-up area will be kept by Kamlesh Builders. So what is the law telling? He may give me after 5 years, or 3 years, or after 10 years. I don't know. We entered in JDA. So 60-40 is the sharing ratio. He will give me after say 5 years. In between, if the JDA is cancelled, what will happen, sir? I paid on the date of entry into agreement. Mumbai High Court is saying the day you enter into JDA, that very day pay tax. So I pay tax. I don't have money. Why I gave for joint development agreement? Because I don't have money. I cannot fund my project. That's why I given to Kamlesh Builder. Now the question is, I took borrowed loan, I paid the tax, 20% tax I paid. Point number 2, what if the JDA gets cancelled? Who is going to refund me? There is no question of any refund by the department. Number 3, what about 54F? Post 2014, a residential house has become one residential house. Word added is in India. Careful. Earlier, as many houses I used to sell, as many houses I could buy. So now it's not possible. Law is crystal clear. One residential house. What was a residential house? There was Karnataka High Court judgment in Anand Basappa's case, KG Rukulima's case. So I could sell one house, invest in 4 houses. Not an issue. Now this is not possible, sir. They are telling one residential house in India. So it is again a problem. Then again the problem is, one more problem is, what about my taxability? So when to pay? Whether in the year of, on the day of entry to JDA, or in the year in which I have received constructed area, or what is how to calculate sale consideration, whether it is cost of construction by Kamlesh Builders or the fair market value of the land surrendered, whichever is higher. Like this, so many permutation and combination were there. The law finally attained finality, and this I must make it a point. I will mention that chartered accountant also who fought for us, and we should not forget him. He raised this point several years ago, and that chartered accountant raised the point was finally accepted by Honorable Supreme Court in Seshasai Steels. Now the law is crystal clear, no question of any confusions of JDA. What are they telling? There were various modes. What was the first one? On the day of effective JDA, whether there is capital gains. Chaturbhuj Daras Kapadia, no. At the time of receiving super build-up area, Adam Prakash himself, Delhi High Court, no. Or Kivraj Motors or Ved Prakash Rakada or SN Construction, Builders and Construction, etc. What is that? The art of construction in the hands of the builder. That also can be a sales consideration. No. Now what are they telling? No. What you do? Then again, I will tell you how the law developed. Then we'll decide. First, Chaturbhuj Daras came. Then beautiful AAR came. Jaspir Singh Sarkaria, Punjab High Court. They told not only on the day of entering to joint development agreement, when you sign the GPA, General Power of Attorney, the law developed along with possession. So then the law further developed. Balbir Singh Maini Supreme Court judgment. Balbir Singh Maini Supreme Court judgment says unregistered joint development agreement is invalid in law. Unregistered joint development agreement. He didn't go into the merits. Balbir Singh Maini. Balbir Singh Maini says your joint development agreement is unregistered. Yes, sir. No question. You cannot invoke 2 within bracket 47.5, 2 within bracket 47.6, read with section 53 of the Transfer of Property Act 1882. So it is unregistered. Why? The Balbir Singh Maini is telling there is an amendment which happened when by Amendment Law 2001. What has happened? Amendment Law 2001. There is an amendment section 17, section 49 of Registration Act 1908. What is it telling? Unless the JDA is registered, section 17, section 49. Unless the JDA is registered, you cannot invoke 247.5. If you cannot invoke 247.5, then you cannot. There is no transfer within the parameters of 2 within bracket 47. So it is simple. Then Jasbir Singh Sarkaria, then I told you this Balbir Singh Maini, law further developed Seshasai Steels. Now this has come to a halt. Seshasai Steel says, no, what you are giving a license is only a license. You are giving permission to builder. Now I gave permission to builder to enter my land. Complex builders, I gave permission, you come enter my land. Merely signing the joint development agreement, merely giving the permissive authority, I am giving permission. Come to my premises and start. You are advertising. Then builder will come, he will take all the permissions and then he will start constructing. So merely giving that authority, that permission is only what? A license under Eastman's Act, section 52 of Eastman's Act. So they are telling it is not a capital gains at all. This sentence, what is there, Eastman's Act, was given by late Sri N.C.S. Raghavan. Ditto the Supreme Court took what sentence our N.C.S. Raghavan sir argued, our Ashok Raghavan sir's father or Arvind Raghavan sir's father, ditto argument, ditto sentences. It was long argued by N.C.S. Raghavan. No, what you are giving is only a license. It is not, does not amount to transfer. As per Eastman's Act, you are just allowing the builder to come. Where is the activity which has happened? Unless I allow him, how will he start building? How will he start taking the approval, the permission, the sanction, etc.? So he told it is only a permission under Eastman's Act. It is not it does not amount to transfer. So that is why Seshasai Steels is telling GPA, sign the GPA coupled with possession. Whenever I get the possession, I should get the super built-up area. At the time only there is capital. Very simple now. Coupled with license, coupled with possession. Seshasai Steels is saying what N.C.S. Raghavan told 20 years back. The Supreme Court finally accepted that in Seshasai Steels. Law is made crystal clear. With effect from 1st of April 17, I gave you the background because we are going to discuss 45 within bracket 5A. What is 45 within bracket 5A now? So what the finance minister told, yes. Now, when will the liability to pay capital gain tax arise? Only in the year in which project is completed. Okay? Only in the year in which project is completed. Now, what is the section telling? Understand carefully. Here and there, you can accept, you may ask question. Then and there, I am telling you, you ask question. Wherever you feel free, immediately ask question or give you a suggestion. Now, I am starting the deliberation on 45 by way. This is the background, sir. With effect from 1st of April 17 onwards. 45 by way is telling, forget 45.1. Notwithstanding anything contained in subsection 1, that means 45.1, forget that. Where the capital gain arises to an assessee, being an individual or HUF, okay, from the transfer of a capital asset, being land or building or both, under a specified agreement. So applicable only to individual HUF, transfer of a capital asset. What is the capital asset? Being land or building or both. Under specified agreement. What is specified agreement? Registered agreement. Why? Clearly I told you, unregistered JDA, there is no transfer within bracket 47.5 or 6. Therefore, 53 of Transfer of Property Act, section 17, 49, etc. we discussed. From transfer of a capital asset, this section applicable only to individual HUF. From transfer of a capital asset, what is that capital asset? Land or building or both. Therefore, for heaven's sake, it does not apply to tenancy rights. It will not apply to all, the development rights, etc. Under specified agreement. What is specified agreement? Registered agreement. Then, when will the capital gain be chargeable? Income of the previous year in which the certificate of completion for the whole or part is issued by competent authority. That means what, sir? When I sign the joint development agreement possession, that time there is a transfer, but the taxability is postponed till the year of completion certificate. Okay, capital gain will be chargeable, it is postponed. Like your 45 to conversion of capital asset into stock in trade. I convert my the year of conversion. Okay, similarly they are telling here there is capital gain, but in the year in which you enter into that registered specified agreement, there is capital gain, but I will not tax you this year. When will I tax you? I am postponing it in the year of completion certificate. And for the purpose of 48, stamp duty value on the date of issue of said certificate. That means the completion certificate, whichever year I receive, that will be what? On that day, I should take the fair market value, that is telling the stamp duty value of his share being land or building or both in the project. Of his share being land or building or both in the project, as increased by consideration received in cash, if any, shall be deemed to be the full value of consideration received or accruing as a result of transfer. Very good. Now we are starting. This is only 45.5. Notwithstanding anything contained in subsection 1. Yes, sir. 45.5 overrides 45. No. Where the capital gain arises to an assessee. Who is the assessee, sir? Only applicable to individual or HU. From the transfer of a capital asset. Very good. What is the capital asset? Only land or building or both, sir. Don't tell me tenancy rights, development rights, any other rights. It is only strictly land or building or both. Under specified agreement means registered agreement. Then when year which will be taxable? It will be taxable in the year in which you receive the completion certificate. What is how to calculate consideration? Stamp duty value on the date of issue of certificate. Now this is funny line. Very poor drafting, sir. I am sorry to say. See this funny line. Understand the impact of his share being land or building or both in the project. What a joke. I am the landowner. I have given my land to Kamlesh. I told you what is the ratio till the last. This is the example. Listen carefully. I gave land to Kamlesh to get 60% of built up area, 40% retained by Kamlesh. Have I transferred my land to Kamlesh? Of his share being stamp duty value of what is sharing? Of his share being land or building or both in the project. Land always belongs to me. Why should I take the fair market value of land as the sale consideration? I will take only 60%. See, I am getting 60% of built up area. Why? For giving 40% of land to Kamlesh. 60% of land always belongs to me. On that, Kamlesh has done the construction and given to me 60% of built up area. But he is telling no, of his share being land or building. Land or building, why should I take both the fair market value? I will take the fair market value or guideline value. Sorry, guideline value, stamp duty value. Stamp duty value only of my 60% of built up area. Land always belongs to me. What am I getting? I gave 40% of land to Kamlesh, then only I get 60% of built up area. That 60% of land always belongs to me on which Kamlesh did the construction. So I don't agree with this. I am anywhere going to knock on the doors of the High Court. Fine. Of his share being land or building or both in the project as increased by consideration received in cash. No problem. So there should be here consideration in kind in built up area as well as cash. Only if there is cash you cannot invoke this 45.5. If the consideration received in cash you cannot invoke 45.5. Then shall be deemed to be the full value of consideration as a result of transfer of capital asset. First provision. Provided the provisions will not apply where the assessee transfers his share in the project on or before the date of issue of certificate of completion. He is required funds now. Suppose I require funds, so I will not wait till Kamlesh gives me the built up area or till he receives the completion certificate. Therefore, what will happen? Normal provisions will apply. Shall be deemed to be the capital gain shall be deemed to be the income of previous year in which such transfer takes place, and the provisions of this act, other than the provisions subsection, shall apply for the purpose of determination of full value of consideration received or accruing as a result of such transfer. So, if I were to liquidate my share, sell my share, gift my share, whatever, before the issue of the certificate of completion, then they are telling capital gain shall be deemed to be the income of the previous year in which such transfer takes place, and the provisions of this are other than provision subsection, that means other than 45.5, shall apply for purpose of determination of full value of consideration. Now the meaning of competent authority. Who is competent authority? Authority empowered to approve the building plan by or under law for the time being in force. Again issue, sir. Competent authority, what is the meaning given in Income Tax Act? Listen carefully. They are telling approve the building plan. Suppose I am giving one big site to Bliss. I am telling you plot. You plotting me, is plotting into sites and giving me back. Where is the building plan for plotting? Or there should be land and building, or can I only land? Suppose I gave big land to Kamlesh and I told 60 to 40, same thing. 60% of the land area will be given to me after plotting. 40% will be retained by Kamlesh. So what do you mean by building plan? Competent authority authority means the authority empowered to approve the building plan. Why you are under any law for the time being? First, here there is no building plan. Specified agreement. What is specified agreement? Means a registered agreement in which a person owning land or building or both agrees to allow another person to develop a real estate project on such land or building or both. In consideration of what? Of a share being land or building or both in such project, whether with or payment of part of consideration in cash. So that means what? You want to have, a calculation without litigation means how you have to calculate. Entire land you have to take. Entire land I have given to Kamlesh, and whatever I receive 60%, again I claim indexation. So entire land you will calculate. I will not calculate only my share. I am telling that entire land I gave him. He in turn gave me 60% of land or building. That is one way to calculate. Or another way to calculate is how I suggested. I will take my sale consideration as guideline value or stamp duty value of 60% of built-up area which Kamlesh should give me in the year in which there is receipt of the completion certificate. And less index transfer of position, etc. What will be the index transfer? 40%. Why? I got 60% of built-up area for having surrendered 40% of land to Mr. Kamlesh. What is stamp duty value? Value adopted or assessed or assessable by any authority of the government for the purpose of payment of stamp duty in respect of immovable property being land or building or both. Always telling only applies to land or building or both. Now move forward. So 45(5)(a), my dear friends, a bench of Hyderabad bench, 3 bench have held that it is only prospective in nature, it's not retrospective. So applicable only from 1st of 17 onwards, it's not retrospective in nature. Scope of section is limited as I told you. Why? Applicable only to individual and individuals. So we don't know why it does not apply to firm. Why does it not apply to LLP? Why does it not apply to company? Why does it not apply to cooperative society, etc.? There is no rational, no logic behind excluding such assets. Then, as I told you, sir, what is the asset here? Only capital asset is only land or building or both. Therefore, 45(5)(a) will not apply to transfer of tenancy rights, leasehold rights, booking rights, rights in land or building. Booking right, I am taking you now. Suppose Gautam were to apply for a BDS or KADP or BDS. So you know that KADP, that lease, first he has to take land on lease. Then site is allotted to him. 10 years he will make the installments. 11th year it is allotted. 11th year site is registered in his name. How to calculate capital gains, sir? 12th year itself he sold. So how to calculate capital gains? DDA has come already, board circular is there, DDA is there. Case laws are there. I think Vinod Jain is their case law, or Jindas Panchan Gandhi, Gujarat High Court. I think Jindas Panchan Gandhi or Vinod Kumar Jain, 2 case laws I remember. It is telling that the date of allotment, that very day, you have to calculate for period of holding. So that 10 years you can easily calculate indexation, nothing to worry, because that site would have been allotted in say 2020. Then 10 years that KADP, PD, etc. Every year installment will pay. Site is registered only in 24, but allotted in 20 or whatever, that 10 years period. So don't worry, that period of holding, cost, and it will be a long-term capital asset, indexation, you will get it, PDA. So this section does not apply to tenancy rights, leasehold rights, booking rights, rights in land or rights in building. Interesting case law is there, Sanjeev Lal is there, Supreme Court. They say even sale agreement you enter, sale agreement, it amounts to transfer. But this is in a different context, 3 bench member. Sessionized here is a 5 bench. This is 3 bench. What is it? What is Sanjeev Lal's case? It is beneficial to the assessee. What happened in this case is, in Sanjeev Lal's case, what happened? He entered into a sale agreement. He sold his property in 2000. Sale agreement. Then he got the advance or the sale consideration. With that he purchased the house. And he claimed 54. Or he sold the house and only via sale agreement, and he purchased the house out of that advance money received. So because of some litigation, 2000 he purchased he sold the house via sale agreement, but that sale deed was registered in 2024. So more than 3 years are over. So in between he took the property, he is telling what to do now. So Supreme Court only for the limited purpose 54. No. What happened? She told at that time itself, you received an entire sale consideration and you had also given the possession of the property. Lal's case is beneficial to the assessee only from point of view of 54, the sale agreement. Otherwise, Suraj Lamshed is their Supreme Court judgment. Suraj Lamshed is telling what? Unless there is sale deed executed, does not amount to conveyance. Only if sale deed is registered, executed, then it amounts to conveyance and transfer of property. Section 54 of transfer of property. Anyway, so this 45(5) are not applicable to transfer of tenancy rights, leasehold rights, booking rights, rights in land or building. Nothing to worry. Now please understand in this section, date of transfer is frozen. What is the date of transfer? There is a date of transfer is different, sir. Date of calculation of capital gain is different. Date of transfer, you know, when you enter into that specified agreement, there is date of transfer. Understood? When to calculate capital gain is postponed till the year you receive the completion certificate. So that is why date of transfer is frozen on the date of entry into specified agreement. Now, therefore, next is period of holding. Period of holding, what to do, sir? Period of holding, what to do? Tell me. Now, what is this period of holding? What is the weird scenario? Now, suppose an assessee transfer of property again. What I am telling you is, suppose I entered into a JDA with Bliss, same thing. I purchased the property today. I purchased the site today. I'll tell you some weird situation. I purchased the site today. Within 6 months of the purchase of site or the property, I entered into JDA with Bliss developers. Only after a period of 6 months after acquisition. And let us take an example, the completion certificates say issued after 5 years after such transfer. So registered development specified agreement entered into within 6 months of purchase of property. And CC is received after, say, 5 years. So capital gain would be taxable when, sir, only after a period of more than 5 years from the acquisition. But as how? Only as short-term capital gain. Since the period of holding between acquisition and transfer, today I purchased the site, entered in joint development agreement, registered agreement, is amounts to transfer. So within 6 months I entered transfer. So now I is telling it's only short-term capital gain. Whereas I received the completion agreement after 5 years. I understood, sir. So there is an anomaly here. Again, I have to knock on the doors of High Court. Please understand, this is a difficult situation. As per law, if you tell me, strictly short-term capital gain. Why? I purchased the property today. I gave it for development to Bliss developers. Specified registered agreement, joint development agreement, no problem. Within 6 months, I have given. I have not get the property for more than 24 months from the date of transfer. Before the date of transfer. So therefore, law is telling, although the completion certificate is received after 5 years, law is telling what? Your transfer took place on the day of entry into registered development. Land was held only for 6 months. Whereas I am taxing it after 5 years, the receipt from CC, but I will tax it as short-term capital. This is the problem. So therefore, this is a problem again. So there is no such specific provision, sir, to clarify how to calculate period of holding. Why I give this example? Nothing is there, sir, in 45(5) which will how to calculate period of holding. So there is a problem here again. Move forward, sir. Indexation. Now from when to calculate indexation. So what is indexation? All of you know section 48 provides for mode of computation of capital gains. And second proviso to 48 provides for indexation of cost of acquisition in case of transfer of long-term capital asset. Now, indexation will benefit will be given to the extent of cost inflation index till the year of transfer. Suppose a land or building acquired by an individual before 2001 and the same is transferred for development under JDA to the developer as on 31st March 19 and completion certificate issued sometime in April 25. That means long-term capital gain arising to the assessee and transfer of asset will be chargeable tax in 26-27. While it appears that the index transfer of the asset will be computed by taking has no money, no capital to pay tax, neither has received any constructed area, etc. Very good. So I am postponing when until the year of completion certificate. Very good. So earlier, now please understand how are you calculating the sale consideration? You are calculating as per the guideline stamp duty value. So 25, 26, 26, 27 in this example, when my tax amount is postponed, guidance value will be much more than when in the year of transfer, that is 1920, house part department income. If I would have paid the tax in 1920, guideline value will be low. If I pay in 26, 27, guideline value is much more higher. So here is the question of benefit to the associate. In any case, even in 26, 27, what builders gave me, they get only constructed area. I don't have money, sir. You would have given me advance or refundable deposit or non-refundable deposit, etc., etc. But still he has given me only constructed area, which I have to anywhere liquidate or dispose of and then pay the tax. So please don't think that this is a beneficial provision. I do not know how they are telling that this is a beneficial provision. I, for one, I am of emphatic opinion this is not a beneficial provision at all to this, because you have to pay tax on a much higher scale, because the guideline value is much more in 26, 27 than when you compare it to 1920 financial year or 2020 assessment year when the specified registered agreement is entered into. Now, see, here again, these are all I am telling you, it is not that easy. Litigation will be there. So, now in this, I am taking you to one litigation point. Again, this will go to High Court. See, there is a beautiful judgment of our Karnataka High Court. Wonderful judgment of our Karnataka High Court has given beautiful judgments in context of 54 have very, very benevolent provisions. Very interesting. You can go to online, you put Naveen Kariwal and CBC. I have got some 30-35 issues for the Mumbai Chartered Accountants. Only 54 have 2 hours lecture only for that. Various issues are there. Karnataka High Court has given some stupendous decisions, all to the benefit of the associate. Anyway, this subject matter is not of 54F. One more day we will do that. Please understand now, I am connecting something with something. Make a case out of something. Now, 45-2, you know what happened? 45-2, you know, sir, this judgment is delivered in context of 45-2 by Karnataka High Court in the case of Rudra Industrial Commercial Corporation on 25th of January 11. 45-2, where what was the issue? Allowability of benefit of indexation in the case of sale of stock, which was converted in stock from investment. This conversion of capital asset into stock in trade. So you know, in the year of conversion, till the year of conversion only indexation is allowed, not till the year of sale of stock. But in this, you know what the High Court held here? High Court is telling harmonious interpretation of these two provisions. Which provision? Explanation 3 to section 48, it defines index cost of acquisition. As well as 45-2, it says first you find out what is the fair market value of asset on the date of conversion. So in 45-2, understand carefully, when will you find out the fair market value? Is on the date of conversion. What is the fair market value of the asset on the date of conversion? Then you find out the market value of property on the date of transfer. So in order to compute capital gains payable, it is the market value on the date of transfer that is relevant, and in arriving at that market value, interest cost of acquisition as prescribed on the date of transfer is to be taken into consideration, not on the date of conversion. So Karnataka High Court has gone against the section itself. What they are telling? Indexation to be taken when? Not on the date of conversion. Indexation you don't take only up to the date of conversion. Please take it as prescribed on the date of transfer. Arriving at the market value, index cost of acquisition as prescribed on the date of transfer is to be taken into consideration, not on the date of conversion. So they are telling, what the Karnataka High Court, I am not telling, indexation till the year of taxability of capital gain. Even if the capital gain arose in the earlier year, that means in date of conversion. But you are paying date, when you are paying the tax on the date of sale of stock. But they are telling give the indexation not up to date of conversion, but up to date of sale of stock. That year, even if the capital gain arose in earlier year, please give benefit of indexation. Simple thing, when till the year of taxability of capital gain. And when will the capital gain be taxed? In the year of sale of stock in trade. That's all. Why? Because court is telling market value on the date of transfer is relevant. And in arriving that market value, index cost of acquisition, as prescribed on the date of transfer, you please take into consideration, not on the date of conversion. Fine, sir. Now move on. But now, that's what we are telling. One has to keep the basic difference between 45.2 and 45.5 in mind. In case of conversion of capital asset or investment in stock in trade, there is no actual transfer of asset. What is that, sir? Capital asset or investment, conversion of capital asset in stock in trade? It is called treatment, conversion and then treatment. Treatment in books of account. What is happening? What was lying in investment comes down in the balance sheet as stock in trade. That's all. What was already there in balance sheet, land was there in balance sheet, investment comes to stock in trade. The asset, the owner remains the same. Asset itself remains with the owner. It is not changed hands. There is no actual transfer. Whereas in 45.5a, there is actual transfer of asset at the instance of the transfer. It is only due to the certain practical difficulties arising out of the JDS, the law has deferred the point of taxation. So this is what you have to, you can fight it out. But I don't know what view the judiciary will, take the call. We don't know because it is yet to go to the tribunal. Now, therefore, the question is whether indexation is only up to date of transfer or up to date of issue of completion certificate. Now, so what is our contention is we are giving like this. So Chennai Tribunal in West and Crompton Engineering, in context of conversion of asset in stock in trade, it said that CIA of year of conversion only has to be applied, not CIA of the year of taxation. If the aforesaid ratio is applied, then CIA of year of transfer should be applied and not CIA of the year of taxability. So now we are differing with the Honorable Chennai Tribunal and telling this is our reasoning, our interpretation. Aforesaid decision cannot be applied for the following reason. In the aforesaid case, consideration is frozen on the date of conversion. Under 45.5a, consideration is frozen only on the date of issue of completion certificate. See, 45.5a consideration when I am taking on the date of issue of CC. So we are telling allow indexation also up to date of year of CC. Because consideration frozen when on the date of issue of CC. Whereas in 45.2, when is the consideration frozen? On the date of conversion itself. That is the fair market value. Object behind giving benefit of indexation is to enhance the value of the asset by taking estimated rising cost of asset year by year as a result of inflation. If the indexation is restricted up to the year of transfer as against year of taxability, then what will happen? Who will use the effect of inflation between the period of transfer and year of taxability will be ignored. 1920, 26, 27. That is assessment year 2021, 26, 27. So between this period, is telling if I take CIA of 2021 and not 26, 27, then effect of inflation between the year of transfer and year of taxability will be ignored. This may defeat the objective itself of granting benefit of indexation. What is the purpose of indexation? It is acting as a tool for protecting me against inflation. That is why I am applying CIA. You are telling me apply CIA only till the year of conversion and not till the year of CC. Then what is the point? That is transfer or till the year of receipt of completion certificate. Further, while the indexation during aforesaid period is ignored, the stamp duty value applied will be as on the date of issue of completion certificate year of taxability. Therefore, there is lack of parity. The sale consideration you want to take guidance value as on the receipt of CC completion certificate, whereas indexation you are stopping only till the year of transfer. Therefore, it may be said that the cost inflation index of year of taxability should be applied. So this is we are just trying to create some defense to somehow push the CIA to the year of receipt of CC and not restrict it up to the year of transfer. I repeatedly am telling you again, as of today there is no case law, sir. Even in tribunal you will not find any case law because such matters are one more section. I told him he studied one section. Then he told how many. I told him I studied some 3 pages, but at the end it was written that this section is deleted with effect from 10/11. So then I told him, okay, anyways, then he telling. Then I told him you should know how to study, sir. It is at the end you study first, then you come friend. Again, I am telling you, don't confuse yourself. For example, definition section is section 2 or section 10. So 2 or section 10 within bracket 1, agricultural income, exempt. 10 within bracket 2a, share of partnership firm, exempt, like this. So it is not subsection, sir. For heaven's sake, understand section 2 definition, 2 within bracket 1, it's not 2 clause 1, 2 clause 2. It is a general section, it's a generic section. It is 2 clause. Similarly, 10 clause 1, then it is subclause 2, then subclause 3. It is not section. For heaven's sake, don't use the word subsection. So that section 2 itself is a definition section. There may be 40, 50 definitions in that. You cannot tell subsection. It is clause. So anyway. So clause 4 to proviso to 48 defines index cost of improvement as follows, etc. You know. So what is the issue here? Cost of improvement in case of this 45(5)(a) section. So cost of improvement incurred by an assessee on the capital asset transferred will be recognized only till the date of transfer. Thereafter, only improvements done till the date of transfer, therefore, will be given even if the capital gain is taxed years after transfer. In any case, after the property has been actually transferred to developer, no expenses will be incurred by the owner after the date of transfer on account of improvement of property. Now, what is specified agreement, sir? Issue number 8. What is the definition telling, sir? Specified agreement provides that consideration shall be land or building or both, whether with or without payment or part of consideration in cash. So, legislature has not specified what is the ratio of the part of consideration to be received in cash. It does not say how much should be received in cash, what is the ratio received in cash as well as in kind. Therefore, a question may arise whether consideration in cash can be more than consideration in kind, that is land or building. Going by the spirit of the section 45(5)(a) and use of the language, what language use? Whether without the payment of part of consideration in cash. Section itself telling whether with or without the payment of part of consideration in cash means what? Consideration in cash cannot be more than consideration in kind. Now, come to the next. What happens if the transfer is later than the date of issue of completion certificate? Completion certificate came, I did transfer. It is later to CC. Either it may be in the year of CC or later to CC or prior to CC. All three situations will see, don't worry. Either transfer is the year of receipt of CC or later to CC or earlier to CC. Now the situation is, what if the transfer is later than date of issue of CC? So generally what the section envisages is CC is issued only after the date of transfer, not before the date of transfer. Generally CC is always issued after the date of transfer. So there may be a situation where the transfer takes place only after issue of CC. I am telling you, transfer is taking place after the issue of CC. Practically, in general, it may not happen. But because of the dispute between the developer and owner, for any such reason, the transfer may get delayed. So when is the capital gain happening, sir? Capital gain, arises only on transfer of a capital asset. Therefore, in the case of this situation, it cannot be said that on the issue of CC, capital gain has arisen by transfer is after the CC. So although you have received the CC, because there is no transfer, capital gain cannot be taxed at the time of issue of CC. Therefore, the same has to be necessarily taxed at the time of transfer only. So in this scenario, provisions of 45(5)(a) will not be applicable and the capital gain will be taxed in the year of transfer as per normal provisions of the Act. However, what you have to hold in mind is that provisions of 50C or 43C referring to stamp revaluation will get duly applicable. Have you understood, sir? So this again, one more scenario clear in this case. Now that's what we discussed. What if transfer takes place before the issue of CC? We saw what happens after issue of CC. Suppose transfer takes place before the issue of CC. That is given in the proviso, sir. Provided the provisions of the subsection shall not apply where the assessee transfers his share in project on or before the date of issue of CC, and the capital gain shall be deemed to be the income of releaser in the such a transfer. Second time word is coming, such a transfer transfer takes place and provisions of this act other than provisions of subsection shall apply for the purpose of determination of full value of consideration received or obtained result of such transfer. 3 times in this proviso transfer. Again I will read it. Provided that the provisions of the subsection shall not apply. Which provision? 45 by A. What provisions? That means what? Year of taxability is postponed to the year of receipt of CC and not in the year of transfer. That means what? On the day with the date of registration of the specified agreement. So provisions will not apply. Where the assessee transfers his share in the project. Is a share in the project on or before the date of issue of the CC. And the capital gain shall be deemed to be the income. So if I transfer when before the date of issue of CC, capital gain will be taxable when in the previous year in which such transfer takes place and provisions of the act other than provisions of subsection that is 45 by A shall apply for the purpose of determination of full value of consideration received or accruing as a result of such transfer. That means what? 45 by A would not apply where the assessee transfer is share in the project on or before the date of issue of CC. What do you mean by the share in the project? It's very important. How to calculate? Assessing transfer his share in the project. What is my share, sir? Remember that example crystal clear. I gave a property to Bliss developers 60-40 ratio. I am getting 60% of built-up area. Bliss is retaining 40% of built-up area with him. 40% of land I have transferred to Bliss. 60% of land is always with me only. I never transferred, sir. It is my personal opinion. Therefore, what is that? What is the word here? Transfer his share in the project. My share in the project is what? 60% of built-up area. Is it the interest in the project or is it his share being land or building or both in the project? Farmer would require any specific identification, whereas the land requires completion of building as well as specific identification. Does the proviso apply only when share in the project is fully transferred or would it apply even when share is partially transferred? If the proviso were to apply only when the share is fully transferred, it may frustrate the very objective and taxpayer may resort to transfer of bulk of the share retaining the fiscal portion. If the proviso were to apply even when the share is partially transferred, question is whether the proviso would apply in entirety or would apply only to the part of the share so transferred. If the proviso were to apply fully even when a part of the share is transferred, it would be a case completely covered by the proviso. If the proviso were to only partly apply even when a part of the share is transferred, it would be a case where both 45 by as well as proviso would apply. While section 45 by would apply to the part retained, proviso would apply to the part that is transferred. By proviso applying only to the part that is transferred. Capital gain shall be deemed to be the income of the previous year in which such transfer takes place. Such transfer is not the original transfer but transfer contemplated in this proviso. That is the meaning. In other words, what? The previous year in which he transfers his share in the project, that is before the date of issue of CC, he is liable to pay tax in respect of capital gain on transfer of the original asset, that is land or building under the specified agreement. Understood, sir? That means when? How many transfers are there? I told you 3 times what transfer is. First is when I entered into specified agreement, there is transfer. Say after 3 years, CC is not received. I transfer. There is a transfer. And in the year of CC, actual capital gains will be pushed. So this transfer, which year it takes place, whether on the very date of the specified agreement or in the year in which I transfer before the receipt of CC. What is your opinion? Unless you have the open to charter notes in front of me. What's that? In the year in which you, not in the year of entering into specified agreement. So, aforesaid interpretation is flowing from literal reading of the proviso. However, memorandum suggests that by virtue of the proviso, capital gain will be charged to tax in the year of transfer. So, if I apply this interpretation, there will be issues of limitation whereby department will not be able to pay capital gain tax at all. No extended time period for reassessment or rectification provided. Up to 3 years from that of assessment year, beyond 3 years up to 10 years is any limitation. Suppose the CC is received after 10 years. So, you are telling me gold tax in the year of entering into specified agreement because of limitation period is expired. Then you are telling that I cannot pay tax or shouldn't I pay tax? Can I make the provision unworkable? Can I evade tax? Can I escape from tax? Therefore, year of entry into specified agreement is one transfer. Receipt of CC, taxability of capital gain. consideration would be determined on the basis of section 48, section 50D, etc. Section 48 or 50D. 50C may not apply because what is transferred is not land or building or work but a share in the project. It's not land or building or work but you are transferred your share in the project. So what will be the cost of acquisition respect of the share in the project? How to calculate cost of acquisition? There is no provision similar to 49 subsection 7. However, it is only fair that the FTC adopted for taxing the gains from original asset should be adopted as actual cost. If not, very taxation is vulnerable to challenge on the basis that the cost is not ascertainable. My exemption is 54, 54F. Now you know. Again, interesting, sir. 54, 54F. Why it is interesting now? When is the transfer, sir? Same example. I entered into specified agreement with Kamlesh Mayers. 5 years. After 5 years, I got the CC. So transfer took place before 5 years. What is 54 telling? From the date of transfer, here 5 years are over. So Kamlesh gave me those flats, say after 5 years. So at that time, can I get 54? You will tell 3 years time limit is over. Understand carefully. Because 54, 1 year before the date of transfer or 2 years after the date of transfer, purchase outright a flat or purchase outright a residential house property or within 3 years from the date of transfer, purchase rent, construct the house. If not deposited in capital gain account scheme before the date of filing of return of income. 1 year before the date of transfer or 3 years after the date of transfer. Here after 5 years I am receiving CC. So therefore that 3 years time period is over. I received that constructed area that is CC in the year of CC only it is taxable. Whereas my taxability stops with the taxability though is correspond to CC, the transfer is already arising on the date of specified agreement. So law is telling from the date of transfer, So 3 years is over, what to do? Therefore again I have to not only also take notes. Because I am going to tell you what is the purpose of this project before you are giving me incentive to further invest the sale consideration received on transfer of capital asset into some other form of capital asset. So on all these provisions we discussed that timeline is given to reinvest the sale consideration into new asset with specific reference to the date of transfer. So that compulsory acquisition 54H only will apply sir compulsory acquisition. What is 54H? Compulsory acquisition is done by the government, maybe state government, central government, or etc. 45. When is it taxable, sir? Again, it is an exception to the principle of 45(1). In the year in which you transfer, there is transfer, you pay tax, capital gain, transfer, pay tax. 45 is an exception. They are telling when in the year in which you receive the consideration of the enhanced compensation or the compensation, in that year only pay tax. Not in the year in which there is acquisition. So 45 54H is telling, don't worry. Whenever you receive the money and then you invest in another asset, from that time when only I allow you 54F. But 54H there is no such provision for 45 by where? What to do now? Even 45 investment is converted to stock in trade, and then stock in trade is sold after 5 years or 10 years. And the CBDT has issued circular number 791 dated 2nd of June 2000, which has come out specifically in respect of exemption for 54EA in the EC. In that circular, it was provided that for the purpose of these exemptions, date of transfer has to be taken as date of sale of transfer of stock in trade only. Rajkumar Aditya's case, Chief Bench of Tribunal held in this CBDT circular number 791 dated 2nd June 2000. Date of transfer shall be the date on which stock in trade is sold or otherwise transferred to associate and not on the date of conversion of capital asset to stock in trade. Special bench of ITIT Calcutta in the case of Octavius Steel, special bench has held that on conversion of capital asset in stock in trade, there is no profit as no one can make profit out of himself. Therefore, in view of the CBDT circular and order of special bench of Calcutta, bench of Tribunal Octavius Steel have no hesitation to hold that the assessing officer was also not correct in denying benefit of 54F of the Act to the assessee on the ground that residential flat was not constructed after the date of transfer along with saleable flats. So, one more decision, our Chief Bench of ITIT in the case of Isha Sarogi, dated 2nd of March 2020. It may the circular was specifically for purpose of investment section 54 EA, EPC, etc. However, taking a cue from that ITAT which we discussed, Rajesh Bharatya's case, ITAT allow the extended time limit for purpose of investment according to 54 Act. So, legislature is mindful of the practical difficulty faced by assessing such situation. It may be expected that certain clarification from department side may come in this regard. Till that I am telling you, use this circular decision for the assessor's benefit in this case also. No, in this specifically for 45 there is no judgment, sir. But based on this, definitely you can try to get a relief. But you will have to knock on the doors of regular or high. Similarly, capital gain account scheme. Now again, capital gain account scheme, sir. From when I should deposit? You know, in this exemption provision, there is also provision of depositing sale consideration capital gain account scheme. If the assessor is unable to invest the money within the year of transfer as prescribed under respective section. Mainly a minimum tax planning cost capital gain account scheme. Blindly, whenever there is capital gains, blindly invest in capital gain account scheme. Why? You don't invest even after 3 years, so you have to pay only 20% tax. So 3 years, you pay only 20% tax with that time. Now you pay tax after 3 years, you can earn interest. Earn interest and then pay 20% tax. Similarly, if you have purchased a property in name of a person, suppose that person is say A, person you only in context of capital gain account scheme I'm telling you. So person A is unwell, he is about to die. You sold a property in his name, you deposited capital gain account scheme, he dies. Immediately after depositing capital gain account scheme, he dies, and you are the nominee. Law is telling you withdraw the money immediately as a legal heir, as a nominee. You need not pay a single rupee. You need not pay a single rupee. Otherwise, you know, capital gain account scheme, if I don't utilize 3 years, I can pay tax. Legal heir is entitled. Suppose what happens, that fellow invests in capital gains, and then 3 years, you know, because it's already invested, then the nominee also can invest that. You can withdraw, can invest that, and you claim that exemption. You can claim, although it was sold by the person. Legal heir also can invest because nominee he has received. Okay, there is no problem. So now context of 45 where same should be applicable from the date of issue of CC only as a sale consideration in a manner assumed you are released on that day. So here there is no mechanism for reference to valuation officer. Under provisions of 50C, unlike provision, there is no provision to contest before the assessing officer that stamp duty value exceeds FMV of the property and seek for a reference to valuation officer. Therefore, if a market price of units in a particular project is lower than stamp duty, assessees will be burdened with a higher tax liability. I can't refer to valuation officer. There is no section there. 50C2. Here there is nothing. No valuation officer. 45 by there. Whom to refer? If the stamp duty value exceeds fair market value of property, I cannot go to valuation officer. Section does not provide it for what to do. So this is again one more problem. So 194 IC is what, sir? So to close that provision, 45 by 194 IC is what? Your TDS. So how the section is doing, notwithstanding anything contained in 194 IA. 194 IA, you know, sale of any immovable property other than agriculture land. Any person for paying to a resident any sum by way of consideration, not the consideration is kind, under the agreement referred to in 45 by 10, shall at the time of credit of such sum or payment, whichever is earlier, deduct amount of how much, sir? 10%. So here also the TDS provisions are there. Okay. Now, move further. Now, this is 49.7. So, where the capital gain arises from the transfer of a capital asset being shared in the project in the form of land or building or both, referred to in 45.10. Not being the capital asset referred to in proviso to the subsection, cost of acquisition of such asset shall be the amount which shall be deemed to be the full value of consideration in that section. So, 45.5 we have completed, sir. Any doubt, any suggestion? Or you want me to continue with 50C, some issues, and then we will take the questions, or you want right now we can discuss 45 by that. What is your opinion? Please tell me.
I have an issue, sir.
Please tell me, sir.